Should you be buying your buy-to-let in your own name or in a company? The only way to know is to do the numbers, so let's do them together today. Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. One question I get asked all the time is, should I be buying my property through a limited company or should I be buying it in my own name? And the only real way to know for certain is to do the numbers. So that's what we're going to be doing today. So let's jump into the numbers, and I'm going to show you how you can start looking at calculating some of these things and throwing some of your own numbers in.
So let's start with our example where we're going to buy a £150,000 property, stamp duty 4.5, legals 1,500, a refurb of about 25k. So in terms of the deposit that we now have a deposit of 37,500. Our loan is going to be 112,500, and our interest is going to be at 6%. So money all in, we need 181k to get into this deal. Now let's have a look at the income side of things to see how this fits together. And the key thing here is we've got our rent at 10,800, which is our 900 per month. We've got some insurance, our ICO, some repairs during the year in our accountancy. So our profits are coming in at about 9,500, as you can see. We have our interest on tax on our mortgage that we can claim. So after interest, we've got about just under 3,000. Now, how the tax works is that we take the 9,500, we calculate the tax, and then we get a tax credit on it. So overall, the tax payable on this one is going to be 553. So let us move on to the higher rate side of things, and the profits are still 9.5. The tax is now at the 40%, which is slightly higher than it was before, but the tax in rate relief credit still stays the same because this is the same at that 20% tax relief rate. So for this position, the tax is now close to 2,500, which is obviously that much higher than it was if you're at 20% tax rate. It's also just worth noting that a basic rate taxpayer would end up with just over £2,000 in their pocket, the 2,212. And a high rate taxpayer would only end up with 309 in their pocket. So quite a noticeable difference. Let's therefore move over to a company to see how this is impacted. So our rental expenses are going to be the same. Our insurance is likely to be similar. Our ICO is going to be the same. Repairs hopefully similar. The interest on the mortgage is fully allowable within a company, but the accountancy charges generally are higher in a company. We've got a few bank charges for having it in a company bank account. So overall, our tax is sitting at, or our profit, should I say, are sitting at 2,193, and our tax is therefore at £416.67. So we're left with a distributable profit of £1,700. Now, if we only take dividends up to the allowance, then that means there's no additional tax to pay. And this means that there's money left in the company of 1,776, and then you've got the dividend allowance for that tax year that you've actually physically taken out of the company. Let's move over to when you get the next property in the company, because it's quite important to consider this side of things. And as you'll see, the rental income we've just worked on the basis will be the same as the previous one. There will be some extra insurance. You don't have to pay the ICO again. Again, we've got a few repairs. There'll be interest on the mortgage. But again, the accountancy costs and the bank charges have disappeared as they're not going to be needed to pay twice. So we've got about profits of 3,300, and now our tax has gone to the 627, and our distributable profits are that little bit higher. So if we now look at what we're getting out of the company after that second property, the tax will be about 627, and the money left in the company will now be edging towards 4,500, and you'll have taken your dividend allowance out for the year. So if we go back to the whole bigger picture, you can obviously see here that depending whether you're a basic rate taxpayer or just a high rate taxpayer, there may be some benefits. to actually going into a limited company where you're going to find that the tax position is much better for you and you're going to be paying a much lower tax figure compared to how much money you're actually keeping back for you either now or in the future, especially with the company where you can choose how much money you're actually taking out of it. There are other considerations to be made, which hopefully you'll have found in the limited company video to kind of find out what risks you may have or other considerations whether going limited is right for you.
As you can see, there's quite a few things that you need to take into account and consider when you are looking at this question. And everyone's situation is going to be slightly different. So you need to look about the circumstances that you are, what's your tax rates, what your implications would be for doing this. Is it a couple, you and a spouse, that are doing this, or you and a partner, or is it just you doing it by yourself? All these sorts of things will have an impact on what the numbers will show, and every story is slightly different. So do your numbers and see what your numbers come out at to help you assess what is going to be the right option. A final point to make is, even though today we've spoken about the numbers, there may be other reasons why actually going limited might be the right solution for you. And that comes down to mostly risk. If you're doing something a little bit risky, or you don't want to risk your own home with the project you're doing, you may want to go down a limited company route, even though the numbers point to doing it in your own name. So just have a bit of a consideration of what may be the right option for you so that you can be getting this right. Hopefully you've discovered how to do the numbers when looking at whether or not you should be buying your buy-to-let in your own name or in a company name. If you have any questions or comments, then do please share them. We want to find out how it works for you, and that's the most important thing here. Please do like the video and do subscribe to the channel, and let's make tax less taxing.